Welcome, ladies and gentlemen, to the video. We have an interesting guide to look at, and I do apologize. It appears I have music still running in the background. We have an interesting thing to look at. We are looking at Northwest Healthcare Properties Real Estate, which is down 11% today. Why is it down 11%? Their UK deal fell through, which sucks for investors. They feel really bad if you bought this of the hope. And as the title said, announces that the REIT and the previously referenced institutional investor will not be proceeding with the UK joint venture. The REIT continues to believe in the attractiveness of the UK healthcare real estate market fundamentals, its diversified, high-quality hospital portfolio, and strong track record of active asset management in the region. This basically goes down, process, and meet with numerous qualified investors who expressed interest in the UK venture. The REIT will continue to source an alternative partner to recapitalize its UK portfolio. Remains committed to the long-term capital light objective, targeting a 30% look-through ownership level across its global portfolio. The REIT's high-quality and defensive portfolio remains in excellent shape with an in-place occupancy of 97%, underlined by a weighted average lease expiration of 13.6 years and 82.6% of leases with annual rent index, which contribute 4.4% growth. Now, with the action today, I actually believe you're almost knocking on a 12% yield, so we can go find that. June. So we can literally just do this right now. 0.6667 times 12, which is 0.80004. So you're like barely getting, it's basically 80 cents, let's say. Divided by 6.84, an 11.69% yield. That is massive. Now, like usual, we want to see the track record. How has their track record been? Is there any cuts? Is there anything that should be really scary that we should look at? Scrolling down. Damn, they paid the same amount forever. So they've paid it for 13 years. And now let's go to the website and look at the good old financial statement. Yeah, it's kind of brutal. I feel bad for them. What's their portfolio look like, actually? Hospitals, healthcare facility, medical, life science, research, education. Asian specific. Gross book value is 8.3 billion. Assets under management 10.6 billion. So they're actually kind of a large REIT. I'm actually very surprised by that. Yeah, I want to view your properties. Do you have any? They have nothing in Saskatchewan, but it's mostly US. Okay. Interesting. Now, with that said, let's go to the financial report. How stable is that 11.69% dividend? We will go to the Q1. Yes, they have Q1. Let's go. I always hate it how it's always in the management discussion analysis. Come on. There you go. Must I go further? Jesus, dude. What the hell? Look at that bump. Q4 it was 117. Now it's 121. What the hell happened? Their AFFO fell. Did they issue stocks that they can't pay or what? 50% debt to gross book. Debt to gross book valuation, declaration of trust. Debt including convertible debentures. Huge amount of debt, which again, you should not be surprised. Wow. Oh yeah, no, they issued a crap ton of shares. You guys can see this right here. At least in a year, they issued, what is that, 10, like 9.403 million shares. Okay. And then compared to Q4, they issued about 1 million shares, which, like, that's really bad dilution for just 3 months. So they had floating rate loans that are now fixed rate. So they're really focusing on trying to get their loans under control from the looks of it. They're refinancing near-term facility expires, resulting in a 92.3 million increase in facility limits. Like another refinancing. Like, dude, this thing just has bad. I can already tell this thing's bad with debt. Dude, I would not touch this thing. I would not touch this thing with a 10-foot pole. I don't care if it's like severely undervalued at this level. Like, dude, if your payout ratio jumps that much, it's 4%. Yeah, 4% there too. 4% in 3 months. I would not touch it. I would not touch it because that's risky. And like, awesome. Last year they made a lot more money, so clearly something happened here. Because even in December they made less money, so they're not making enough to pay the dividend. Yeah, like noise up a decent amount. So funds from operation, AFFO is down overall from a year ago, which again it's expected, but like again, look at Canadian net REIT, it's up, everything's up, distributions are up from beginning of the year. Yeah, dude, I'm just gonna be very blunt. Like, don't get me wrong, I'd love to chase this yield that's been here forever, but yeah, I wouldn't buy it because I can see why people immediately dumped it today. Because, like, dude, they're gonna cut the dividend if they can't figure out their debt situation and they can't figure out the dividend situation. I'd be more comfortable buying medical property trust, and like, people hate that one, but this one it's way worse. It's so much worse. Do not buy this REIT. This REIT is like actually going to cut the dividend, just like Hamilton, just like INO, just like TNT. Do not buy this REIT. Do not buy this REIT unless you are somehow, from looking at the financial statement, confident there will be no cut. Or if there is a cut, you're 100% okay with it. Have yourself a good night. I am not touching this with a 10-foot pole. I do not care if the yield is even like 50%. I would never touch this in a day in my life. Bye, everybody.